Welcome to the Money Runner. I'm David Nelson. We have a lot of investors that watch this show, but even if you aren't one, listen up. This could help you when you decide to get started. I don't care whether you're just managing your 401k, your kid's college account, or you're a fund manager investing billions. Investing is an expectations game. And I use the word game because in many ways, that's exactly what it is. Let me make the comparison to sports. Every sport has analysts who crunch numbers coming up with point spreads, player health, you name it. They count everything, and some will even give you the odds of the runner on first stealing second on a 3-2 count. We've all watched that popular movie Moneyball. Baseball has adopted a lot of what we do right here on Wall Street. Fund managers like myself, we have our own version. Analysts crunch endless streams of data to make an informed guess on how a stock or the market is going to perform on a given quarter. It's a guess, I grant you, but it's an informed one. In football, by halftime, you have a pretty good idea on how the game is going. And if you're a bookie, you might lay off some of the risk if the odds are starting to turn against you. Wall Street is no different. Analysts are constantly adjusting estimates to changing conditions, or at least they should be. Unfortunately, 2022, that doesn't seem to be happening. Analysts are starting to get lazy. I'm going to give you a couple of rules tonight. Rule number 1, markets and stocks follow earnings, because in the end, that's what a stock is. It's not just a story. It's a contract with the company that gives you your share of the earnings and or dividends of that company. Look at the chart. That's a lot of data, 30 years. And you can see what I'm saying holds true. The correlation between that white line and that green line, which is the earnings, pretty high. Take a look at this year. Analysts are holding estimates higher while stocks have rolled over into a bear market. One of those two lines is wrong. Just about the only sector where analysts are expecting earnings declines is financials. We came into the year with the glass half full, as banks were expected to be a direct beneficiary of Fed rate hikes to push down inflation expectations. 6 months later, the bigger fear is recession. Now, I said at the top the word expectations. If you don't think beating expectations drives stock prices, look at the outsized performance of Citigroup on Friday. This was a company left for dead. It was sitting at a 52-week low, and it blew away the estimates. The end result was a better than 13% move on the stock. You know, sometimes we forget that an earnings report isn't just a report card on the health of the company. It's a report card on how good or bad the analysts were at getting the estimate right. And in the case of Citi, they obviously got it wrong. All right, I'm going to pivot technology for some obvious reasons here. Probably the biggest disconnect between earnings estimates and stock prices has to be the technology sector. Why is this important? Technology is more than 27% of the overall market. Apple alone is 7%. Add in Microsoft, that's 12%. That's half the sector's value. Year-to-date, analysts have been reluctant to cut numbers in this sector, which in many ways is counterintuitive. Think about it. How many of us bought a laptop because we were working at home and needed to up our game, maybe back during COVID in 2020 or early 2021? We were never going back to the office, so we needed technology in the home. We pulled forward a lot of demand. Now, Barron's, the very popular financial magazine, touched on this very subject this weekend, saying this is about to change. Goldman's semiconductor analyst Toshiya Hari cut his estimates by 20% because of current macro conditions. That's what they discussed in the article. And of course, this makes perfect sense, given what we know. Semiconductor stocks, as you can see in the SMH chart, guys, can you pull this up? They've been pricing in a downturn all year. Now, trust me when I say this. This is exactly what we need. It's exactly what the market needs. We need analysts to accept reality and stop holding on to stale projections and estimates. All it does is set up investors for big disappointment. In the end, it will send markets lower. Now, like I said earlier, games have rules. And rule number 2 is that beating expectations is important. The good news is that there are analysts like Mr. Harry willing to make these very tough calls. The bad news, there are still too many waiting for the horse to cross the finish line. They're waiting for management to tell them what to do. All right, I covered a lot of ground. That's it for tonight. Don't forget we post every morning the Market Minute to break down the important news to help you get ready for the trading day. Give it a try. Sign up for the daily briefing. Thanks so much for joining. I'm David Nelson.